Today, we will talk about listing requirements for stock exchanges. Listing requirements are the criteria and minimum standards established by stock exchanges, such as the New York Stock Exchange, that companies must meet to list their shares for trading. A company will be allowed to list shares for trading only if it meets initial as well as ongoing requirements. Companies that do not meet listing requirements on major exchanges may be able to offer their shares for trading over the counter, OTC. Listing requirements are a set of conditions which a firm must meet before listing a security on one of the organized stock exchanges, such as the NYSE, the Nasdaq, the London Stock Exchange, or the Tokyo Stock Exchange. The requirements typically include a certain size and market share of the security to be listed, as well as the underlying financial viability of the issuing firm. Exchanges establish these standards as a means of maintaining their own integrity, reputation, and visibility. Once a security is listed, the issuing firm usually must maintain a set of related but less stringent trading requirements to avoid delisting. Listing requirements vary by exchange, but there are certain metrics which are almost always included. The two most important categories of requirements deal with the size of the firm and the liquidity of the shares. A certain number of shares must already have been issued. For example, the NYSE requires firms to already have 1.1 million publicly traded shares outstanding with a collective market value of at least $40 million. Usually, an initial listing fee as well as yearly listing fees are required. The annual fees can scale up depending on the number of shares being traded and can total hundreds of thousands of dollars. Nasdaq fees are considerably lower than those of the NYSE. This lower cost has made the Nasdaq a more popular choice of exchange for newer or smaller firms. Yes. If companies fail to pay annual fees or they can no longer meet the financial and liquidity requirements of an exchange, they can be delisted. Also, if share prices drop below a certain minimum, a company can be delisted. Once delisted from a particular exchange, investors won't be able to trade a company's stock on that exchange. Here are 3 key takeaways. 1. Companies must meet exchange liquidity and financial requirements to have shares traded on a stock exchange, and also pay both initial and ongoing yearly listing fees. 2. Listing requirements vary by exchange and include minimum stockholders' equity, a minimum share price, and a minimum number of shareholders. 3. Requirements ensure that only high-quality securities are traded on an exchange, maintaining the integrity and reputation of the exchange and reassuring investors. Hope this would help. Thanks for watching.